All right. Hello. Thank you for being here. Welcome to the American Family Insurance Dream Bank, where we believe in the transformative power of dreams. My name is Eric Lopez, and I am a dream curator here at Dream Bank. And on behalf of our team, we're glad to have you with us. Here at American Family Insurance, we believe communities are stronger and the future is brighter when people are actively pursuing their dreams. That's why we created Dream Bank, an inspirational community destination and digital experience dedicated to dreamers everywhere. Our offerings are designed to help you celebrate the dream journey, overcome obstacles, and stay motivated. Now, I'd like to introduce you to our speaker for today, Jonathon Ferguson. Jonathan is the owner of FG Financial, a financial education and advising service based in Madison, Wisconsin. FG Financial's mission is to assist individuals, partners, and families with achieving their goals and aspirations through financial education, empowerment, and action. Alongside his work with financial services, Jonathan worked in higher education for 15 years, assisting clients explore career possibilities and achieve career success. If you have any questions for our speaker, please go ahead and write them in the Q&A section here in the chat, and we'll go ahead and try to get to them at the end. Before we start, I would also like to mention that this event will be recorded and you will be able to find it on our Facebook and YouTube page later this week. Now, I'll go ahead and pass it over to you.
All right, thanks so much. And hi to everyone. I appreciate you joining today. As was said, my name is Jonathon Ferguson. I'm here today to talk with you all about building a meaningful retirement plan. We're going to go through lots of different things today, so I encourage you to have your pen and pad or your tablet or whatever works for you. Obviously, for auditory learners, this will be easy because you'll just be able to sit back and listen. I put together a slideshow to try and help with the visual pieces as much as possible. But if maybe you learn more kinesthetically, you prefer actually having a pen pad or a tablet just to doodle or whatever you need to do to be able to stay engaged in the session. So happy to be here with you all today. So next slide here, just a little bit about my background. You'll see my credentials there, but the main point of this slide is for me to just share that money sometimes can be challenging to talk about, especially when there are these gigantic mountains that you need to overcome, which sometimes retirement can be viewed in that way. Because there's just so much to plan for and so many ifs about it. And so I just wanted to take some time to say, like, from this presentation, take what you think is helpful and leave what's not. And do your best to keep in mind that this is pretty relatively speaking, low stakes joining in for this session, but can be super meaningful for you as well, because you may get some nuggets of information and ideas and things to think about for the future. So it's a great launching pad, and it's good to just kind of enter with an open mind as much as possible and not put too much pressure on yourself, especially when you're thinking about things like retirement, which can be pretty full of information. My background is one that's not based in finances. It's come from humble beginnings, lower income class, and so I've been fortunate enough to just learn over time and have opportunities to build my confidence in managing money, and then became so passionate about it that I wanted to help people be able to experience the same thing. All right, so the session details, make sure I go over what we're going to talk about today. We're obviously going to talk about money. I'm a financial advisor, and we're talking about retirement. It's going to be impossible not to talk about money. We're going to talk a significant amount about that to get you all some information that I think will be helpful to launch your exploration into retirement planning. But we're also going to talk about other things that are not money related, because oftentimes those are the things that are going to drive the planning that you're doing with money for retirement, everything else in your life. So we're going to need to take a couple steps back and look at just life generally and what makes you happy, what makes you satisfied and engaged. As I said, take notes. Personal finance is personal. So we're going to talk about a number of different things. A lot of them are general guides, and those are good places to start. But ultimately, to get to where you want to be, it can be very beneficial to connect with a financial professional to build a plan that's specifically for you. So just keep that in mind. And then allow yourself to dream. Try and remove any limits that maybe life has placed, or maybe you've placed on yourself. I mean, I'm guilty of that as much as anyone else. Like, I couldn't possibly do that. That wouldn't work. Sometimes it's just helpful to remove those things. Not that those limits aren't real, but sometimes removing them from your thought process can help you build a plan to overcome what those limits actually are, or at least combat them. So try and suspend those for now, would be my recommendation. So allow yourself to dream a little bit during this session. Okay, so we have to start with what is retirement. I think a lot of the times it's easy to jump to strategy and to jump to which account do I need to save in? How much do I need to save? And I think it's good to just take a step back and ask yourself, what am I actually trying to do? And then that's going to provide a lot more clarity as you move forward. So the question about retirement is, what is it? And in my opinion, and I think you all would likely agree with this, it's a departure from a previous experience. But sometimes the emphasis on the departure from the previous experience, in my opinion, can be too high. The way I like to think about it, I was just talking with folks about my history and working at universities. Like when someone goes to college or attends college, their focus is usually on the attending of college. It's not about the leaving of high school, right? And so obviously that's a part of it. Like, you graduate from high school, maybe you had a really good time in high school or not, not such a great time depending on your experience. And that follows you into college, but your focus, if you're going, is on college. But sometimes with retirement, the focus is on leaving the previous thing, but not arriving at where you're going to be in retirement, whatever that means for you. So I think it's important to put the focus on the arrival as opposed to the departure, and it's going to enable you to be able to build a better plan for yourself. So my point is, think about it as launching into a new experience primarily, as opposed to a departure from a previous one. I would encourage folks to do that. It might open up different ways of thinking about retirement that improve whatever your experience will be in the future. So give that some thought. And then last but certainly not least, you got to think about what the important components of retirement are. And what I find is the important components of retirement are likely going to be the things that are important in life generally that you just need to give further thought to. So we'll move ahead here. So you can see what I mean. So what is the retirement experience? What I encourage people to do, and I encourage you to do, is to think about this in a number of different ways, but 3 specific questions I'd like you to ask yourself. And I'd like you, if possible, to come up with 5 to 10 answers to these questions. Obviously not right now. We don't have enough time here today to spend this much time on this this portion of the session, but I think it will help you to be able to determine what are you actually trying to do as part of your retirement experience. So community is where I would start. And generally speaking, let's say, who do you want to spend your time with in retirement? This is going to help you build a better picture of what retirement is and what that experience can be or should be for you. So hopefully there are people who come to mind right away. You don't actually have to think about it. You just like, bam, right away. You know exactly who you want to spend time with. But then you might need to give it some further thought and think about the folks who don't come to mind right away that you actually want to be a significant part of your retirement experience. Secondly, activities and involvements. What will you do with your time? Right. So if we think about a traditional modern retirement experience, you usually work at a job 40 hours a week. You may travel to and from that job up to an hour a day. You might have in your day 30 minutes to an hour for lunch. So you add all that up, you're looking at 50 hours or so a week that you're going to have found time. What are you going to do with it? How are you going to spend it? What's going to bring you joy? How are you going to have a meaning or a sense of purpose in that time? Those are things that you always want to think about as you're thinking about retirement, but just life generally. And then environment, I think, is important too. Where are you going to be? And I did say 5 to 10 answers I think are helpful. Obviously, you might say, well, I want to live in this place, or I want to live in this house, or I want to be in this community. But are there places you want to travel? Are there different areas of the country or the state or even the community you want to spend your time? Things like that. So all of those things I think are really helpful and can help you basically paint a more accurate picture of what you want your retirement experience to be. Once you've done that, then I think you can start thinking about some of these financial implications with planning and those kinds of things. And that's what we'll start moving into next. So what I'm going to do is present multiple models of retirement. I think there's a default model that we often think about when it comes to retirement, and it's this first one that we're going to talk about, the traditional modern model of retirement. But there are more than that. You don't necessarily have to do it this way, and I think that's important to note. And so a question you'll want to ask as we're going over these models, based on your answers to those 3 questions, you could ask yourself additional questions, of course. Which model might fit you best based on your answers to those questions that we just talked about? So the traditional model, generally speaking, and I'll say like these are 3 models I'll present, but there are grades in between and many others, but I wanted to go with 3 distinct things so you get a sense of the choice you have. So 30 to 40 years of work. So this is, you start working professionally or full-time in your late teens or early 20s, and you continue that to your early 60s, mid 60s, and then you quote unquote retire. So it's about 30 to 40 years of work. Unfortunately, with many people that I've talked to, this involves sticking it out until the end of your career. Having a background in career development, I think there are many other ways to think about that, but certainly sometimes there are just some realities of life that result in people sticking with work that they don't necessarily enjoy as much as they used to, or maybe never enjoyed, but it brings to them things in life that they really want or feel that they need. And so oftentimes you'll see people stick it out until the end of their career with this model. And hopefully that's not the case for you, but we do see that. In addition, oftentimes it defers items on a bucket list until mature years. So the bucket list meaning things that you want to do that are like dreams for you that you just like, hey, I have to do this thing. It would bring me lots of fun, lots of joy. Oftentimes with the traditional modern model, those things are deferred into your retirement years, which begin in your 60s. Typically, can be earlier in the 50s for some folks, but typically in their 60s. So question comes, how much money do I save for this model? And the benefit of this model for saving money, one, is that it takes advantage of, I would say, the most powerful tool in saving and investing, which is time, right? So if you begin saving pretty early on, you have what's called compound interest over time, and it enables you to better be able to meet the goals that you want. So it does take advantage of that. So there are some general guides when it comes to how much money you should save, right? There's no great one place to start for every individual person, but you got to start somewhere. And here are some guides for you to be able to start, to be able to like kind of pencil in or stay on track towards the traditional modern model. So saving and investing 15% of your annual earnings each year towards retirement, right? So just to keep numbers very broad. If you're a couple and you make $100,000 a year total, then you're going to want to have 15% of your annual earnings, which would be $15,000 going towards retirement each year in order to quote unquote stay on track for reaching your retirement financial goals. We find that in a financial planning community, there's some general agreement with that thought that that will be enough to get you there in combination with some other things that we'll talk about later. When we think about how much you need to have, right? So there's this thing called the 4% rule, and I don't want to nerd out too much on this, but I'll go over it very briefly. So the 4% rule states that whatever bucket of money you have, and this is based on research that was done by a retirement researcher several years ago, whatever bucket of money you have at retirement, you can withdraw 4% of that money on an annual basis, adjusted for inflation each year, and not run out of money based on a 30-year retirement. So if you retire at 65, let's say you've got $1 million in retirement, just to keep numbers very broad, you can withdraw $40,000 of that on an annual basis, and as adjusted by inflation. So let's say inflation's 3%, you would do 3% in addition to the $40,000 that you took out the first year. You would do that in your second year, and then that would keep you on track, and you just adjust throughout retirement, and you would not run out of money. So that's one thing to think about. The other thing to think about is, generally speaking, a good target for how much money that you'll want in retirement is going to be 80% of what you had before you retired. And so the reason for that is, let's say you make $100,000 a year, and you were saving 15% towards retirement, and then you retire. Well, you don't necessarily need to be saving that 15% anymore, right? So you already have a reduction in what your need is. And then additionally, there's some other things that may come down in cost for you in terms of like travel to work, clothes for work, so on and so forth. So you're going to usually want about 80% of what the lifestyle is that you're leading or what you're earning at that time. So you have to determine, what's that look like? If you decide that $100,000 is a good fit, then that means you're going to be looking at $80,000 a year. And so if you work backwards, not to get too nerdy with the money, you use the 4% rule and you say, all right, so $80,000 is 4% of what, right? If I know I need that in an annual, like on a yearly basis in retirement, $80,000 is 4% of what number? And so then you kind of go from there and kind of work things out. So that's just a broad overview of where you are and where you can be to help you kind of stay on track. Okay, so that's a traditional modern model. Another model is the FIRE model, Financial Independence Retire Early model. Some of you all may have heard of this model. And I appreciate this model because it's taken the traditional modern model and said, that doesn't work for me. I want to do something different. And I just appreciate that in itself, that people are being creative and doing what they think works best for their life. So oftentimes these folks work in a high earning field, and they're going to work, quote unquote, for a certain amount of time. I've just chosen 10 to 20 years here because that's often the case with folks who are in the FIRE community. And then after that, they're retired, quote unquote, but they still work in some way, like on passion projects, things that they feel are really meaningful for them, may not be as lucrative, but provide them some level of income moving forward. All right, so maximize earnings and spending. The downside of the FIRE model is it doesn't take advantage of time, right? You don't have 40 years to plan for your retirement and save and invest for it. Instead, if you're shooting for 10 years, that's what you got to get this bucket of money that you need to be able to support you moving forward in life. So if you're losing out on that incredible tool for saving money, then the only way to kind of supplement it is to raise how much you're saving and decrease your lifestyle. Right. So oftentimes you'll see folks who are in this community who are in higher earning jobs. They're living with multiple roommates. Sometimes they're living off ramen and they're eating a lot of that because that's what makes sense for them to achieve this goal. Right. So it's whatever works best for you. But you also got to be cognizant of sometimes, if you're in this community, it taken too far, you're kind of losing out on your life right now, not doing the things that you want so you can have this desired end later. And obviously the extreme version of that is not healthy either. So that's something that you have to think about. Once they hit retirement, quote unquote, at age 30 or 40 or whatever it is, they're usually living modestly throughout retirement because even though they have a big bucket of money saved up, they've got a long life. Remember that 4% rule is based on a 30-year time frame, right? So for folks in this community, when you're looking at the 4% rule, it's based on a 30-year time frame. That's what the research is. If you're looking at a 60-year, quote unquote retirement, the 4% rule may be appropriate for you, but it may not, right? So you'll want to make sure you're thinking about what's the best process moving forward there. And so how much money you should save, forecasting is going to be required as opposed to the traditional modern model. You need to forecast way in the future because life changes and you're not sure what's going to go. This one, you're not going to need to forecast nearly as much because it's much sooner. Your retirement date, that is. All right, and then there's this last one, the lifelong mix model is what I call it. And this is where you're working in a career in one or multiple fields pretty much as long as you can work, right? So it doesn't mean you're going to retire at 60 or 65. You might work until 80 if your health allows you to do so. And because of that, you're saving modestly and consistently over your lifetime, but you're mixing in these quote unquote retirement experiences throughout your life, right? So you might work in a career for 10 years and then decide you want to do something else, go back to school, retrain, enter a new career, and that might take you a year or two to be able to do that. Or you might take a sabbatical where you go do a service mission for 2 years and then come back and re-enter the workforce. Or you might take just an extended break and go out and travel the world in the middle of your career and then come back and continue working too. So it's sort of a mix. You're doing both things all the time. So you're including your bucket list items throughout your life. And because of that, forecasting isn't as important because you're consistently earning income. You don't necessarily need to well, how much money do I need at this one time when I'm going to retire? Because you're just always working. There's still going to be some saving that you need to do to take advantage of some of the benefits for saving in tax advantage accounts, but it's just not the same as some of the other things. So I encourage you to think about these 3 models and which may fit you best or what you like about each or what you don't like, because then that's going to help you evaluate how do you get to retirement and what that should be for you and drive your financial planning for it, which is what we're going to enter right now. All right, so folks who were waiting for the money stuff, here we go. We talked a little bit about it already, but it's important to dive in. So first thing I want to say is there are many options to fund your retirement, period. There are many, many different ways to do it. And that's something that we'll talk about today. We're going to just look on some common financial planning strategies for retirement because we can't cover them all. And I want to cover things that are clearly retirement planning and then things that people are doing that's not necessarily things that come to mind when they think about planning for retirement, but they're doing it or at least considering it, and it's going to benefit them as well. So the first is tax advantage investment accounts. These are otherwise known as retirement accounts. I like to think of them as tax advantage investment accounts as opposed to retirement, because you can make these accounts mean for you whatever they mean, right? If you're in a lifelong Mixed model, you may use tax advantage investment accounts even though you don't necessarily plan on retirement for quite some time or forever. There are taxable investment accounts. We'll talk about that, where you don't have the same tax advantages. You still do get some, but how those can fit in. We'll talk about home ownership. A lot of times people don't think home ownership as a retirement vehicle, but it absolutely can be and is, and support you in your retirement, whatever that means for you. And we'll talk about the Social Security program, which is something that people are contributing to if they're working and have earned income. That we don't necessarily think about as retirement, that we're contributing to it every year, but there are some important things to keep in mind there. There are additional options, as I mentioned, like investing in rental properties, being a landlord and building funds that way. And then there's some insurance products like permanent life insurance and annuities. And an annuity is basically a product that you can buy to guard against the risk that you're going to run out of money. Right. So it'll provide you a stream of income once you quote unquote hit retirement. And usually if you set up the annuity appropriately, that stream of income will come throughout your life, no matter how long that is. And so sometimes it provides a little bit of safety. And then there's some things with life insurance that can be helpful as well from an investment perspective. And then there are many more. So these are the things we'll tackle. All right. So first, tax advantage accounts. This is the, like I said, the default model, the traditional modern model. And so tax advantaged accounts as it relates to retirement are all built around this model. So it works extremely well for it. So most of the funds in these accounts are not meant to be available until you're at least 59 and a half years old. There are some, there's some random times where you can get to the money before then. But most times there are penalties or some other kind of consequence or specific situation that needs to happen for that. Then you have a big decision that people have to make, which is traditional savings or Roth savings. And pretty much that is a bet on your tax rate. And if it's going to be lower now than it will be once you're 59 and a half or older, or vice versa. And so most of these accounts are going to give you an option to save pre-tax or to save post-tax. So just to touch on that really quickly. So let's say you make $50,000 a year and you contribute $6,000 to one of these accounts and you do that in a pre-tax way. What that's going to mean, with some exceptions, so we won't dive into it, but generally speaking, what that's going to mean is if you do that in a given year, so let's say in 2022, you donate, that's how I think of it, you're like donating, putting towards money towards your retirement, $6,000, that means that your tax bill that you get from the federal government is only going to be based on $44,000, right? So you don't pay taxes on that additional $6,000 that you've saved. The reverse of that is you put the $6,000 in there in a Roth account and you pay the taxes now, and you're usually doing that because you think your tax rate's going to be higher later. So that's just a broad overview of how that works. There are employer-sponsored retirement accounts like the 401k, 403b. 401ks are usually for private companies or corporations. The 403b is usually going to be for some kind of government entity. And then some people have access to a pension, but at this point, that's less than 5% of workers, if you believe the reports that are out there, which I do. So you don't see that as much. And then there are other things as well. So you can save in these accounts and really take advantage of compound growth over time. Downside is you have a limited autonomy over planning, right? So whatever your retirement account provides you as options, that's what you take, and that's going to come through your employer. And there's not much you can do to determine that. You can influence it by talking with your HR if it's not exactly what you're looking for. And then there are matching contributions by employers, which are great. And so basically a matching contribution is you put a certain amount of money in, they put a certain amount of money in. So it can be a dollar for dollar match, and that means you're getting 100% return on your contributions, which you just really can't beat that anywhere. There are IRAs, individual retirement accounts, which basically you set up separately than work, and you're working towards your retirement. So you'll have that pre-tax and post-tax as well, and you get to determine a lot with that. Downside is you have lower annual contribution limits here, and so that's usually going to be somewhere in the neighborhood of $6,000 to $7,000, depending on your age currently. So those are some things to think about. Tax advantage accounts, you need to consider these things. Funds are not readily available until mature age. So you're pretty much putting this money up until you, quote unquote, gain more experience in life. I'm not going to say get old. You gain more experience in life. That's when the money is going to be available to you. So they're not they're not liquid, right? That's just they're not available. You have to think about the long-term impact of traditional versus Roth. What I'll say there briefly is Roth has some really powerful results long term. You're paying the taxes now, but later in life, it really can benefit you. So you want to look at that, and I really wish we had time to talk about that. I could go on and on about the benefits of Roth accounts and how they can help people pending their situation, but you really want to look at the long-term possibilities when it comes to a Roth decision. Sometimes the challenge here is golden handcuffs, right? You got a great deal from your employer and you just can't leave, even though you don't want to. It's like, oh man, this pension plan's so great. The match is so great. And so sometimes that some people have to combat. It's like, I can't go even though I really want to if it weren't for this thing. You have an opportunity for lifestyle creep. All right. And so lifestyle creep, the more you make money over time, you need to be aware of this. Like I think I was just talking with folks about cruise control. Like if I look back at the car I had in my teens, I didn't have any cruise control. And then I got cruise control. Then I couldn't live without cruise control. And then I got automatic cruise control. I don't know if you all know this, but there are cars. You just hit a button and the car just follows the road, and it slows down when you need it to. It speeds up when you need it to. Like now, like I can't live without that. Right. But if you apply that to every area of your life, your lifestyle is going to go up, and thus you're going to need much more money for retirement. That 80% number that you're looking at is going to be 80% of much more because of lifestyle creep. And I'm not saying that you shouldn't take advantage of this new technology that's available to you and this increased funding that you have, but you do need to be aware of it and how that might impact your retirement planning. And then I'm not going to spend much time on this, but proper planning for matching contributions. If you work for an employer and they have a match and you contribute throughout the year, this is not going to be, and you just say like every paycheck, I put a little bit until the end of the year. Great. If you don't do that and you front load your contributions, let's say you're like, I'm going to put all my retirement money in for this year through my employer in the first 3 months of the year, which some people do because they're very proactive, so on and so forth. You need to ask your employer if they have a true up feature in their plan. This is very important for folks who do that. You need to think about it if you fit that category. I wish we had more time to talk about it, but we don't. It's very important if you front load your retirement savings through your employer plan because of a match. Okay, taxable investment accounts, uniquely helpful for FIRE and lifelong model, lifelong mix model. This does not require you to wait until you're 59 and a half. You invest in stocks, bonds, so on and so forth, and you can do whatever you want with that money at any time. It uses after-tax dollars, so money that you have left over after you've paid your taxes and so on and so forth. You invest in these accounts. And as I said, those are the investments. There are no annual contribution limits. So you can kind of do whatever you want with that. If you've got $10,000 to throw in, great. If you've got $50,000 to throw in, great. If you've got $3,000 to throw in, great. There's not like these limits you need to pay attention to. Benefit of this is you have a lot of autonomy. You can invest in just about anything you want to invest in. You can take money out whenever you want to take money out. That also has its challenges, right? As we know, the stock market right now is in one of its down times. And one of the worst things people can do, purely from a financial planning perspective, one of the worst things people can do is remove their money from investments when they're down. It's not great to do that, but when you have an account like this, it's just more likely for you to do something like that because you just are much more involved. Short-term and long-term capital gains, very important. When you buy an investment in a taxable investment account, a short-term gain is something that you bought, you sold in the same year for more money. You're going to pay usually a much higher tax rate, your marginal tax rate, as opposed to if you bought it, didn't do anything with it for a year, and then sold it, you're going to pay something called a capital gains rate, long-term capital gains, and that's usually going to be either 0% or 15% for most people. And both of those rates are usually lower than what your marginal tax rate is going to be, your top marginal tax rate. Something else you got to think about is where your investments go. Asset location is what the fancy finance people call that, right? So that means like if you want to invest in real estate through something called a real estate investment trust, you really need to think about, is that an appropriate thing to put in a taxable investment account? The reason why is because that's an investment that yields lots of ongoing income, thus lots of taxable ongoing income that might be better suited somewhere else. So you just got to think about that. Where do I put these different types of investments? And then exchange traded funds and mutual funds, right? When you invest in a stock, you're basically investing in an ownership of a company, a share of a company. You can do that directly. You can say, I want to just invest in a bunch of stocks, hundreds of them, and you do that through something called a mutual fund or an exchange traded fund. Those things are taxed differently, and so you need to take that into account. And an exchange traded fund might be more advantageous for you if you're investing in a taxable investment account as opposed to a mutual fund, even though they have lots of similarities. And then just important to tax planning, it's enhanced. You got to really think about that. All right, let's keep going. Home ownership works well with these models here. The beauty of home ownership is that it makes use of wealth building debt. And so there's this thing out there called leverage. And that means you put your money in something and it costs you a lot and you're actually in debt. But having that debt long-term empowers you to be in a better place afterwards, right? Because with a house, let's say you spend $200,000 on a house and you have $150,000 worth of debt because you bought it through a mortgage and you put a $50,000 down payment. Over time, you're gonna actually be able to reap the rewards of that debt because that house is gonna go up in value and you're gonna continuously own more of the house. That's what equity is, by paying the bill each month. And so you actually end up in a better place long-term because of the lower interest rates that housing comes with. So it appreciates over time. As I just said, you earn some equity if you purchase with a mortgage. Maybe you're one of these folks who are lucky enough to buy a home outright with cash. It does happen, but that's not the typical way things go, but something to consider. And it locks in your housing costs at today's rates, today's costs, right? So if you buy a house, well, actually, let's just take it back. Sometimes, you'll hear like an older family member talk about their house and they're like, 1960, I bought this house for $35,000, right? And they did. And we know that they were able to lock in that cost back then. So their monthly payment was based on the status of money, the value of money back then. But over time, money, it grows and it becomes much different than it was previously in terms of how much you need to buy something. But you're still paying what it was in 1960, even when it's 1970, when it's 1980, when it's 1990, when it's so on and so forth. So you really lock in your cost, and that can be very helpful. And then if you get to retirement and you own your house, you've improved your cash flow. You don't have a house payment. You don't need to pay that anymore. And so you have more money available to you. And then the tax advantage of Section 121. This is a little nerdy as well, but I think is important for people to know. Basically, it means, depending on if you buy your house as a single person or a couple, you have a certain amount of money that you can gain through the sale of that house, either $250,000 or $500,000, as long as there aren't any complexities. And that money's not taxed. You sell the house. So if you buy it for $100,000, you're a single person, you sell it for $349,000, that $249,000 of gain, you don't pay any taxes on. It's pretty powerful. So it's something to think about. Considerations here: short periods of ownership don't balance out upfront costs. They just don't. You need to live in a house for quite some time. If if you're going to balance out the down payment and the fees that come with buying a house, you don't want to do that and expect to live in a house for 2 years. You'll actually end up losing more money. Sometimes that happens and you can't control it because you got a new job or something else changed, but ideally speaking, that would not be the case. You need to be aware of recurring maintenance costs. So you want to save 1% of your home value each year over time, just to be able to keep up with that on average. The money is not readily available. All of this money you're putting in your house, you can't just go to the bank and take it out, right? There are ways to get to it through things like a home equity loan or things like that, or something called a HELOC, a line of credit. That's through your home equity. But you got to take some steps to do that. That's just not as easy as like, I'm going to go get this money out. And then some data does show, this is important to know, that having outright home ownership is correlated with retirement happiness. There are many in the financial planning community that say you should take as long as possible to pay off your house. It's low interest debt. You should leverage it as much as you want. But what we find is sometimes that's not what's going to make people happy. And the point of money is to make people happy, right? And so what I would encourage you to do is think about what's going to make you happiest. And if paying off your house within a certain time frame can do that, then think about, well, what's the most effective way to do it, and figure that piece out. But we do know it can come with retirement happiness, because then you're not concerned about it. That basic need you have is taken care of when you're in retirement. All right, so last thing we'll talk about here is Social Security. We've all heard of it. It's designed for the traditional modern model. It provides replacement income for American workers, right? So everyone who's working pays 6.2%. I believe that's the most recent number. I don't think that's changed, into Social Security basically every paycheck. And if you're paying that, that is really money towards your retirement. You may not think of it that way, but that's what it is. And so you are contributing to your retirement, even if you don't think so. The beauty of Social Security is when you get to that advanced age, that mature age, and you start collecting a benefit, it comes with a cost of living adjustment. So each year, as inflation goes up, your benefits are going to go up to match that. So that's not a given with many things. So that's very powerful. You have to think about that. Downside is you can't access the funds until reaching ages between 62 and 70. And you have to think about when you're going to start collecting these benefits. So you've got these 3 ages for the majority of people right now, where you can start collecting at 62, a certain benefit. If you wait until 67, it's a much higher benefit. And if you wait to age 70, it's the highest it could be. And a lot can go into making that decision, but it's something to be aware of and that you might want to talk with someone about, because it can get pretty complex. Few things to note: Social Security is never intended to be your be all end all when it comes to retirement. It's best used as a supplemental resource for retirement. The decision on when to collect payments can be very challenging, mainly because just as a human, you're pretty much just like, if I take at 62, it's either because I either need the money right now, and that's always going to be first and foremost, like I need this to live, or you're saying, well, I think I'm going to need it now, because if it's just looking at the numbers, I don't actually need it, but I think I want to take it now because I'll get more money from it before I die, right? So, and if you wait until age 70, then you're like, well, that's great, it's the highest, but there's this break even point between, if you wait to 70, how long you need to be alive to actually overshoot the amount of money you would have had if it was at age 62 when you started. So it's just kind of morbid. It's not very fun, right? So it can be challenging for that reason. And then there's an impact on your spousal benefits too, especially if your spouse worked inside the home throughout their life. They can collect some benefits as well, but it's a little bit different and can be more complex. You don't have much autonomy with determining the success of the program. There are a lot of people who argue that Social Security is not a well-run program. It doesn't provide the return that someone who's contributing over their lifetime should have. I'm not going to debate with that because the situation is what it is, and all you can do is insert your influence through civic engagement. But the financial strength of the program is unstable. I do want to be clear about that. It's not as stable as it needs to be. You can look at ssa.gov for your intended benefit, and AARP has something as well. For conservative planning purposes, my recommendation is to discount, or at least considering discounting your benefit by 25 to 30%. And the reason why that's the number, because if the Social Security program was actually stable financially, that's the number that most people would be getting moving forward, which is somewhere between 70 and 75% of the benefit that they're currently getting, right? So you could plan completely conservatively and say, I'm not planning on Social Security at all. That's up to you. Or you can say, I want 100, I'm going to plan for 100% of what my intended benefit is when I look on the website. That's your choice as well. In my opinion, considering that 70%, 75% number can be helpful. All right. Other things to think about. These are other things we're not going to talk about, but there are lots of other possibilities for retirement planning. When you think about what you want, you run through those models, which fits, and then you think about how I save, what helps me be able to get to where I want, right? And then you figure out which tools are going to do that for you. Healthcare is important. If you're going to go the traditional model, for sure, you need to know more about Medicare and what you need to do to sign up. But that's with all models. Anytime you reach advanced age, Medicare is going to be there for you. And you need to have awareness of this thing called IRMA, income related monthly adjustment amount. Basically what that means is when you're in your advanced age, if you have higher income, you're going to pay more for your Medicare benefits. And this is where, remember I talked about the traditional and Roth, this is where something like that can come up to be very important, because Roth money later in life is not considered income. Traditional savings are when you withdraw them, and that can impact things like IRMA. So just important to think about. You can talk with your financial professional about that. And you always want to have the appropriate asset protections in place, disability insurance, your long-term care plan, trust. So if you want to protect your information, trust can be a really helpful thing. Or if you have a heightened amount of money and you need that to assist you with a wealth transfer, that can help as well. Long-term care helps cover some of your medical bills down the line. So you might think about a policy there. And disability insurance is something that I think everyone needs to think about while you're younger, because basically what that's going to do is protect your income if for any reason you become disabled, which statistically speaking, there's a much higher chance of than actually life insurance, which is passing away, unfortunately, early. There's a much higher chance of you becoming disabled as opposed to being someone who passes away early, unfortunately. So you got to think about that. And then, of course, all the fun stuff, we save all the fun stuff for the end, legacy and estate planning. You want to think about having a will in place, and certainly healthcare and financial powers of attorney. So if you can't make certain decisions for yourself related to your health or the property that you own or your finances, it's good to have someone in place to be able to do that when you're thinking about retirement. And everyone needs a will, instructions on what to do with your stuff, It's just helpful for everyone to have, make things much easier down the line for your loved ones who are going to be managing while obviously going through something very challenging, and healing from your passing and celebrating your life. So all things to consider. A few indicators of being on track, and then we'll get to questions here. Can you describe your retirement without using the word retirement? If you can do that, then you've got a pretty good picture of what your retirement means to you. And then also, are pieces of your retirement experience included in your current life experience? I'm always going to advocate for that. I do think there's power in deferral of things, but that can be taken to an extreme as well. You do have a life now, and it'd be helpful if you lived it and did some of the things that you wanted to do. So something else to consider. And then secondly, can you identify specific financial goals associated with your retirement? If you can do that, you're probably on track, or at least have a greater likelihood to be. And do you have checkpoints for achieving those goals? I think if you can do both of those things, or actually all of these things on here, if you can answer them well, then you're on track. And whatever happened before, that's over. So I'd say focus on the now, focus on the remedies, things you can do now, and don't focus on the things that have happened in the past, which may be considered faults. All right, so again, my name's Jonathan. You can reach me at fgfinancial.com. I'd love to be able to talk with you individually to help you build your retirement plan. And I hope you all have gotten at least some decent information here today. I know it was a lot of info to throw at you all, but all good things to think about, and to serve as a launching pad for your planning. All right, so I'm going to throw things back over to Eric so we can get some questions going.
All right, thank you so much for that presentation. It was definitely great. We do have a few questions. So Sherry asks in the Q&A section, what are the options for folks who want to pursue the FIRE model but aren't in hiring fields? Oh, higher earning fields, I guess. SOL.
Well, so the FIRE model, so the stereotype of the FIRE model, I'm just going to live in stereotypes for a second here, is the high earning engineer who's got 6 roommates and is living off low cost food, makes $100,000+ a year, and can live a very modest lifestyle. And they want to do that for a short period of time. But the reality is you can be financial independent, retire early. It just may not fit that. So if you're not in that income field, maybe you retire quote unquote early at age 50, age 45, age 53, and you built the plan for yourself. So it can be much more individualized. So it's all about lifestyle, right? You got to answer that question. But once you know what lifestyle you're comfortable with and when you may want to retire, then I say you figure that out, and then you see how it can work. And one of the ways to do that is to really have some time to self-reflect, think on it, and then talk to someone about the strategy. Now, lots of people would love to talk with you about that. I love talking with people about retirement because it's usually something that they dream about. So that's it. You can do it. You don't need to be in a high earning field to do it. Just means you probably won't do it in 5 years, 10 years, because that's just not going to work. You haven't been able to save enough to be able to do that.
Gotcha.
It's a good question.
Yep. And then also another one regarding the FIRE method as well. Is it possible with children?
Well, of course it is, but then it means that brings in another complication, right? And from a financial planning perspective, because when you're deciding, like, if I were a single being, I can decide, like, this is the life I want to live. I'm willing to eat this ramen, like beans and rice, awesome. But when you have a child, right, there's the emotional decision you have to make to decide, like, well, what life do I want for this child, right? And that's real, and you have to answer that. And then there's the financial piece, which we know it costs money to raise children, right? It just does. And so it can happen, but again, it's really thinking about connecting with someone to strategize on it after you've really explored and answered the questions about what you want, what you think is right for your child. You can also ask your child. Maybe they have some thoughts on it. I'm told the children are I don't have any children of my own, but I'm told they're very bright. And sometimes they have golden nuggets of information. But in all honesty, in all seriousness, I think the reflection you have as the adult, and then just talking with somebody about what's realistic, and they'll tell you.
Gotcha. Perfect. Yeah. Definitely have to ask around, right?
Yep.
And then let's see. We do have another question saying, can you please suggest any good websites to research retirement communities and continuum of care communities? Also, please suggest a good website for to research on how solvent these communities are.
Oh, yeah. So there are some good websites for that. If you're looking at retirement communities in the traditional definition of it, meaning usually they have a minimum age 55, 60, 65, and you're going to live with a lot of other people who fit that description. They should have it, one, so they should publish that on their website about that. And then there are, and the website eludes me. Oh, brain fart. So I'll have to follow up on that. So I don't know if there's a way for us to get more information to the attendees after the fact, but I'll send out, or I'll provide Eric with some information that can be sent out, or at least post it about where to go for that. But they should have it. And then there's also an association that kind of manages some things like that too. So I'll get you some information on that.
Perfect. And then I guess another question is, can a financial planner help me sign up for things like Social Security and those programs you need as you are reaching retirement age, instead of just counseling me on my investments?
Hopefully. So a financial planner should be looking at your full picture, and that includes Social Security, and everything else related to your life. If you're planning for college for your kids, your housing situation, your insurance, your cash flow, all these kinds of things. If they only want to talk to you about investments, then they're probably an investment advisor, and they may be making money off of the number or the amount of funds you have provided them to invest. And so they're mostly interested in that and not necessarily all the other things that are going on in your life. And if you have an advisor like that, you just want to ask them, one, how do you make money, and what will you talk with me about? Those are two honest questions. And if the answer is, well, I won't talk with you about all these other things that are important to you beyond investments, then I think you want to find a fiduciary financial advisor or financial planner that'll look at your whole picture and kind of help you understand all the possibilities, not just investments, which are important, but they're not the only thing. They're just one piece of the financial picture.
Yep. I think that's great. Yeah, definitely knowing what you're going to pay for before you pay, right?
Yeah.
Or like sitting down, asking them like, hey, do you cover all these subjects before you go ahead and commit to them? Sounds like a great idea. And open lines of communication. That's a solution for a lot of problems, right?
Mm-hmm. Yep.
Great. And then, so let's see, one other question. I think this might be one of the last ones, depending on how quickly we can get through it. How early, at what age should someone start investigating Medicare options? I've heard the process can be quite lengthy.
Well, Medicare is something you'll sign up for when you're 65. And so I think it's helpful to have a general idea of what that looks like as you approach that age. But usually, I would say within a couple years, a year beforehand is when you really need to be knowledgeable about the process and when you sign up and all that. Because if you miss signing up, I don't have a lot of time to talk about this, there are some penalties that can come later and things that aren't happy times, right? We want only happy times, right? So so making sure you sign up at the right time is important. You can always get that from the website at the government. I forget the actual URL right now, but if you just put in Medicare into your search engine and GOV after that, you'll be able to get some good information there. But I would say a year or two beforehand, you need to be really tied into it, not only for the Medicare stuff, because you need to be aware of how being eligible for Medicare can decrease your medical costs and thus relate to the rest of your financial program, whether it decreases it, how it fits in. So if I had to pick an age, I would say 63. You better really, really be thinking about it and be aware of it. Before then, just know that it's coming.
Gotcha. Perfect. That's great advice. Thank you so much. I see we are at 1 o'clock, so I think our time is up. I'm just going to go ahead and give a brief outro before we let you all go. Thank you so much, Jonathan, for your time today. And thank you so much for everyone else that has joined us. Here at DreamBank, we truly believe in the power of dreams and celebrate that our community is made up of fearless dreamers. As we wrap up, actually, one last question for Jonathan. So yeah, as we wrap up, we like to ask our speakers, what is one piece of advice that you have for someone who's pursuing a dream right now?
I guess the piece of advice I would have for someone who's pursuing a dream right now is to stick with it, even if it doesn't work out, and don't let that result deter you from following future dreams. Right. So it may not work out in a certain time frame you've already got built. So I encourage you to stick with it. But even if long term it doesn't work out, try not to let that be a barrier for thinking about other things you want in your life and dreams that you want to achieve. So stick-to-itiveness, I hear people say that. I don't think it's a word, but I hear people say it. So have some stick-to-itiveness and a community of people who support you and that stick-to-itiveness, that align with you and support you in being able to do so. I guess that would be it.
Perfect. Thank you. That's definitely a great suggestion and great tips. And then lastly, so yeah, we look forward to continue to learn, grow, and dream together. You can learn more about our upcoming events on at American Family Insurance DreamBank website and by connecting with us on our social channels. On behalf of American Family Insurance and DreamBank, we look forward to hosting you again soon. Until then, keep dreaming fearlessly and thank you. Goodbye.